For the first time in 6 years, Bitcoin's engine has hit the brakes because miners are abandoning the network to chase the new AI gold rush. Here's the thing. Bitcoin's engine just hit the brakes. For the first time in 6 years, the total computing power securing the network actually dropped in the first quarter. That's a big deal. We've been riding a wave of non-stop growth since 2020. Every single year, the hash rate went up. It was like a train that never stopped. Now the train is pulled over. It's down about 4% so far this year. And this is where it gets interesting. It's not because the network is broken. It's because the miners are getting bored. Or rather, they are getting greedy. They found something else to do with their money. Let's talk about the math. It's simple. It costs about $90,000 to mine one Bitcoin right now, but Bitcoin is trading at $67,000. Do the math, you are losing money every time you turn on a machine. It's like running a lemonade stand, where the lemons cost more than the lemonade sells for. So what do the big players do? They don't just sit there and bleed cash. They pivot. They're moving their capital into AI, artificial intelligence. That's the new shiny toy. The returns there are higher and way more predictable than mining Bitcoin. It's a classic case of chasing the easy money. Public miners are selling off their Bitcoin and taking on debt to buy AI chips. They are shifting gears. And because they are pulling back, the total hash rate is falling. It's a direct reaction to the price. When the price is weak, the machines turn off. When the price is strong, they turn on. It's that simple. Now some people are panicking. They see the hash rate drop, and they think the network is going to crash. They worry about security. But here's the twist. This might actually be a good thing. For a long time, a huge chunk of the mining power was concentrated in the United States, like over 40%. A lot of it was controlled by a few big public companies. That's not exactly decentralized. It's a bit of a bottleneck. If those big guys pull back, the power spreads out. It forces the network to become more geographically distributed. It stops the big players from having all the control. So while the headline looks scary, the underlying structure might be getting healthier. It's a shift from a few giants to a more spread out network. But don't get too comfortable yet. The miners are still watching the price. If Bitcoin doesn't bounce back, more small miners will exit. They can't afford to lose money forever. The forecast is that the hash rate will grow again by the end of the year, but only if Bitcoin hits $100,000. That's the condition. If the price stays stuck, the machines stay off. And look at the holders. It's getting ugly. Nearly half of the Bitcoin in circulation is now underwater. That means people are holding at a loss. The stress index is spiking. We haven't seen this kind of pain since January. Remember last week? Long-term holders were selling at a profit. They were happy. Now, they are underwater. Over 4 million Bitcoin is sitting there losing value. That's a lot of pain. This is the part everyone suddenly gets wrong again. They see the red candles and they think it's a dip. They think the smart money is buying. But the reality is the smart money is moving to AI. The retail traders are the ones holding the bag. It's a classic trap. The narrative gets cemented that this is a great entry. But the fundamentals are shifting. The miners are leaving with their feet. They are walking away from Bitcoin to chase AI profits. So what does this mean for you? It means the market is fragile. It's fragile right now. The price is the only thing keeping the lights on. If the price drops further, the hash rate drops more. It's a feedback loop. Don't let the hype fool you. Just because the price is low doesn't mean it's a bargain.